Okay, let's dive into this. We are looking at an absolutely massive shift in how retail investors interact with the stock market. Because, we've moved way past the era of AI just handing out stock tips or summarizing boring earnings reports. Robinhood just dropped a brand new feature that takes AI from merely giving advice straight into actual execution. Yeah, you heard that right. That means an AI agent can now execute trades with your actual hard-earned money.
So here is how the whole shebang works. Customers can now connect a third-party AI model to what they're calling a dedicated agentic account. They do this using a piece of tech called the Model Context Protocol. Once you're connected, you basically give this AI agent the green light to analyze your portfolio, build trading strategies, and actually place real equity and options orders on your behalf. They're even positioning crypto accounts as a coming expansion. But hold on a second. Before we just hand over the keys to our financial futures, we really need to look closely at what this actually means for us.
What's just fascinating to me here is the stark contrast between old and new automation. I mean, algorithmic trading isn't exactly new, right? It's been around for decades. But traditional automation was this tightly controlled, closed loop. A professional firm picked the data, wrote highly specific strategy code, rigorously tested it, and owned the entire infrastructure. Agentic trading? It completely obliterates that loop. Today, a retail user can grab a general-purpose AI model, open up a chat window, type a goal in plain, ordinary human language, and the strategy is just assembled dynamically in real time. The barrier to entry is gone. But here's the catch. An error in a normal chatbot just spits out a weird sentence. An error in an AI with the power to place an equity order? That produces a very real, very expensive consequence.
Section 1. Who made that bad trade? Which is honestly the literal million-dollar question here.
Let's rapidly walk down the plumbing of a trade to see why accountability is just incredibly complex now. There are really 5 centers of responsibility. First up, you have the user, that's you, who sets the goal. Second is the model provider, whose AI might just be a general-purpose product, not a licensed financial advisor. Third, you've got the broker, who executes the trade, but has zero clue if the strategy actually makes sense for you. Fourth are the data providers. News and quotes can be delayed, meaning an agent could reason perfectly, but base its decision on totally bad input. And finally, the 5th center, the integration layer, which translates the AI's intent into an actual broker command. A tiny glitch here could say, duplicate your orders. When a bad trade happens, the blame gets totally lost in this technical plumbing. Yet our traditional accountability systems are still frantically looking for just one person to point the finger at.
Section 2. The danger of vague instructions. This is where things get really tricky. We are all so used to giving AI these broad, casual commands, right? Imagine you casually type this seemingly simple, everyday instruction into your trading AI. Reduce portfolio risk. Sounds straightforward enough to us. But what does that actually mean to a literal machine? I want you to step into the algorithm's shoes for a second. Does risk mean market volatility? Does it mean maximum drawdown, like the absolute most your account could possibly drop? Does it mean sector concentration? Or maybe it thinks it should account for your taxes, your liquidity, or upcoming earnings dates. You might be sitting there thinking your objective is crystal clear. The broker just receives a perfectly formatted order and executes it. But the AI? The AI genuinely believes it has full permission to choose exactly how to reduce that risk, completely blind to your actual human intent.
So, here is the absolute crucial takeaway for this explainer. When you check that little box for autonomous execution, you aren't just giving a piece of software permission to click a button. You are fundamentally transferring the right to interpret uncertainty directly to the AI model. The broader and more casual your language is, the more the actual investment decisions are being made by the machine, not by you.
Section 3. Why boundaries aren't enough. Platforms obviously know this stuff is risky, so they try to build safety nets. But let's look at why those nets are full of holes. Robinhood, sensibly enough, separates the agentic account from your main portfolio. Let's say you allocate a hypothetical $5,000 to this dedicated fenced-off account. You're probably thinking, okay, great. The absolute most I can lose is $5,000. It acts like a quarantine, right? A nice strict risk budget. Well, not exactly. Sure, the direct capital loss is capped at that initial $5,000, but setting up a separate account absolutely does not prevent the AI from making an economically irrational trade. It just limits the direct exposure of cash. Think about the hidden risks. The AI could easily trigger a massive taxable gain that you now owe the IRS for. It could create terrible, unwanted exposure right before a disastrous earnings call. And don't forget, this agent needs read access to your other accounts to even understand your overall portfolio. which means your sensitive financial data is suddenly exposed way beyond that initial $5,000 wall. Section 4. Speed and options multiply risks. Now we're really raising the stakes.
The very things that make AI so incredibly attractive, its lightning-fast speed and its ability to juggle complex instruments, actually act as massive multipliers for disaster. Take options trading, which is a supported feature. If you just buy a standard stock, your loss is generally limited to whatever cash you put in. But options? Options introduce this whole new layer of complex nonlinear math. You've got expiration dates, strike selection, and implied volatility, which is basically how crazy the market expects the stock to act. Listen, your AI model could literally perfectly predict that a stock is going to go up and still lose every penny of your money because it picked a contract with a terrible expiration date, or because the implied volatility completely dropped out. You ask it to bet on a rise, but you didn't understand the complex mathematical gymnastics it performed to execute that bet.
And then there's the speed factor. An AI can monitor markets continuously, right? But if market data updates faster than your portfolio state does, the AI might start acting on an obsolete view of your account. Imagine setting a poorly specified rule where the AI repeatedly buys after every small price dip just to repair a position. Especially in 24/7 crypto markets, this cascade of errors can literally unfold while you are fast asleep, totally draining your account before you even roll over to check your phone in the morning.
Section 5. The regulatory and technical void. Because if your account does get drained, who exactly is coming to your rescue? Let's look at the actual tech standard Robinhood is using, the Model Context Protocol, or MCP. Now, MCP is a fantastic piece of tech for access control. It uses OAuth, so think of it kind of like a digital bouncer checking IDs at the door of a club to securely verify that an AI client is actually allowed to call a specific tool. But, and this is absolutely vital to understand, MCP only solves the connection part. It does not solve investment governance. It confirms the agent can make a trade. It guarantees absolutely zero about whether that trade is a genuinely good idea or if it's remotely suitable for your financial goals. And on the regulatory side of things, honestly, there is currently no single regulatory category that perfectly covers an AI agent when it crosses the line from being just a helpful user interface to functioning as a de facto portfolio manager. In fact, the SEC actually withdrew its specific predictive data analytics proposal in 2025. Now, this doesn't mean we're entirely in the Wild West, but it does mean the financial system is relying on very old principles to govern brand new, highly autonomous tech. And think about the aftermath. If you want to figure out why an AI completely failed, a normal trade statement just isn't going to cut it. A standard statement just shows exactly what asset was bought and when. But to audit an AI, you need a totally new kind of invasive record keeping. You'd have to log the original instruction context, the intermediate reasoning the AI went through, the specific tool calls, and every alternative it considered. But archiving all of that creates massive privacy risks regarding your personal, intimate financial constraints.
Section 6. When AI should do nothing. Let's talk about how we actually fix this and redefine what a safe product looks like. I absolutely love this quote from the source material for this explainer. In real money systems, quality is defined by the ability to stop. We are so often sold on autonomy, on how many thousands of actions an AI can perform per second. But the most valuable feature of an autonomous AI trader isn't its speed, and it's definitely not its aggression. It's its ability to pause, to recognize ambiguity, and to flat out refuse to execute a trade until it asks you for clarification. Maximum freedom from the AI is not evidence of product maturity. Restraint is. So a truly practical and safe architecture is one that intentionally limits the agent's freedom. It involves minimal capital, quarantined in separate accounts, sure, but it also needs an allow list of specific instruments and strict trade frequency limits so the AI can't just spam orders into the market. It requires hard automatic stops the second a daily loss limit is hit. And frankly, it needs mandatory human confirmation for complex instruments like options or any brand new strategy tries to spin up. To sum up everything we've covered today, we are facing a massive gap between legal responsibility and technical causality. The broker can execute perfectly. The MCP can transmit the command perfectly. The AI model provider can legally cover themselves by stating they aren't financial advisors. Literally every single component can technically work exactly as designed, yet they can all interact to produce a total financial disaster that you are legally on the hook for. Connecting an AI to a brokerage account, that is just the baseline. The real product, the one that will actually protect investors and not just gamble their savings, begins with a safe, rock-solid answer to this one question. What happens when the agent misunderstands the user?
Because when ordinary, everyday human language becomes your primary financial interface, ambiguity isn't just a quirky communication error anymore. It is a direct, tangible threat to your wallet. Keep that in mind before you let a chatbot manage your money.